Hello and welcome to Virtual Investor Conferences. On behalf of OTC Markets, we are very pleased you have joined us for our Clean Energy Metals Conference. Our next presentation is from ACG Metals. Please note you may submit questions for the presenter in the box to the left of the slides. You can also view a company's availability for a one-on-one meeting by clicking Book a Meeting in the top toolbar. At this point, I'm very pleased to welcome Artem Valinets, Founder, Chairman, and Chief Executive Officer, and Patrick Hense, Chief Financial Officer of ACG Metals, which trades on the OTCID under the symbol ACG, AF, and on the LSE under the symbol ACG. Welcome, Artem and Patrick.
Thank you so much. It's great to be here. Let us quickly run through the slides and leave time for the questions at the end. The story of ACG is very simple. It is a company that will be 1 year old in September, in the beginning of September. But we have already achieved significant results. When we created ACG Metals last year through acquisition of a producing asset in Turkey, our resulting market cap was $100 million. Today, we're roughly $90 million, 90% above that. And this is just the beginning of the story. Even though we are just less than 1 year old, we are generating a very significant amount of cash versus the size of our company, roughly $90 million last year and going to 100 plus as we complete our project to start producing copper and zinc concentrate from next year. As of today, we are continuing to produce gold and silver doré. Healthy balance sheet, $133 million in cash. We have a bond outstanding from which we've been drawing to finance capex. But very healthy net debt to EBITDA significantly below 1. The key shareholders include our Turkish partner Lidya, which is a subsidiary of a large Turkish conglomerate, Çalık Holdings, a key partner for us in the country. Argentum Creek is a fund focused on emerging markets based in New York. And have Glencore and Traxys, two global traders. Glencore has copper offtake from our mine, and Traxys has zinc offtake. They both came in as shareholders last year when we completed the transaction to buy this mine. We are currently covered by Canaccord, Berenberg, and from last week by Cantor. Significant upside from today's share price levels. But as we'll show you, we expect this to be significantly higher than the brokers are currently predicting. In simple terms, ACG is a very different from your typical $200 million market cap company, as we made almost as half of that in free cash flow per year. If you compare ACG to our peer group, we're making more money per year than companies such as Eurocopper, which is 6 times bigger than us market cap, and significantly more cash than any other copper company listed on LSE, other than Antofagasta, obviously, but that's a $20 billion giant. We plan to get there as well, but in the meantime, this is the cash generative nature of ACG. And we believe this is a key differentiator. And that is a key driver of a potential upside from today's levels, as we are trading below 2 times free cash flow. Average companies in the sector on average trade at around 8. A significant upside potential is seen through PNAF, which is 0.3, that is typically not applicable to the producing companies such as ours, as well on 2 times EV to EBITDA. The reason for this current undervaluation is simply because we're a new company. The first 2 brokers published their first research in the middle of June. Cantor published last week. We've been only doing marketing for the last 2.5 months. So many things to come going forward. As you can see on the slide, the board that we put together for this company is certainly not for $200 million market cap company. It is already designed to govern a much larger multi-billion-dollar business. I will not go into the details of everyone on this page. Just a quick introduction. Myself, been in mining for close to 30 years. The formative experience for me was 10 years in the aluminum industry, where I led all the key transactions that created the largest company in the world, United Company Rusal. When I listed that in Hong Kong as a head of strategy and a deputy CEO of Rusal, we achieved the market cap of $20 billion. And essentially, that was a culmination of a strategy of rolling up aluminum assets globally. That's what we are looking to do in a different space now, in a copper space, where we started with acquisition of Gediktepe mine in Turkey, and we are looking to add other producing mines globally to build a multi-billion-dollar business in a short period of time. So the board reflects that, including the recent contribution. Mike Pompeo joined us in the beginning of this year and have already been instrumental in setting up key meetings with the heads of the foreign governments in the countries where we operate. The other people on the board include Mustafa, who is the CEO of Lydia, our key partner in Turkey, Martin, the Chief Investment Officer for Argentum Creek, 3 prominent independent directors, Fiona, 35 years in commercial banking in the mining sector, Mark Kutis, former Chief Investment Officer for Global Situation Group of ADIC, still advises this sovereign wealth fund in Abu Dhabi. Obviously, we have our men in this cash-rich part of the world. And Henny Foyle used to be head of copper at Anglo American, which obviously his skills and experience come very handy as we build a global copper company. 2 advisors, Robert Friedland probably does not need an introduction, the key entrepreneur in mining of our generation. Warren Gilman used to run money for Mr. Li Ka-shing in the sector for over 12 years, so well-experienced mining investor. Management will not go through that. I will only say that we have highly experienced personnel, including Peter Carter, Canadian, with 40 years experience as a chief operating officer. He actually used to work for me in my previous company. Graham Ripley, our project director, built 13 projects worldwide, none behind schedule or above budget, and that's what he's doing for us in Turkey. Barış Bas is the local Turkish national who is a director mining of our mine in Turkey, and he leads a team of 300 people, of which only 3 are expats. Patrick, maybe this is the time you quickly introduce yourself.
Yeah, thanks, Artem. So my name is Patrick Hense. I'm CFO of the business. Also spent my whole career in mining. Started in banking, did debt and advisory on the debt side, then moved to private equity. We run and operated and bought and sold a lot of mines in Europe and Central Asia. Then created my own company advising for mining businesses, and ultimately joined forces with Artem just 2.5 years ago to create or to support the ACG business.
Thank you, Patrick. So our first, what I call starter asset, is on the western side of Turkey. It's a producing mine. Last year, we produced 57,000 ounces of gold equivalent in gold and silver doré. This year, our guidance is 36,000 to 38,000 ounces. The numbers are decreasing because we are eating through the oxide cap of the deposit, the top of the deposit that been exposed to wind and air, etc., and got oxidized. So it's easy to process that through a simple heap leach operation, achieving a very low costs. We're in the first quartile of the global cost curve for gold, with around $1,000 all-in sustaining cost per ounce. Obviously, that leads to massive cash margins. We are halfway of building a second phase of the development of this mine at a cost of $146 million. Roughly 50% is complete. A very simple project to build a two-stage flotation and start producing copper concentrate and zinc concentrate, which is well positioned to be processed in Europe. We are 3 hours away from the 3 key ports in Mediterranean, Izmir being the closest one. From there, Glencore and Traxys will be supplying this concentrate to smelters in Europe. It's a fully built modern mine, all infrastructure in place, all permits in place, and we're just doing a brownfield expansion to move from production of gold essentially into production of copper. Patrick?
Yeah, thanks. And as Artem said or showed in the previous slide, this mine is a really high-grade margin, and in mining they say you can't change what's in the ground. So we are really blessed with having such a high-grade mine. You can see here that versus competitive other mining projects from our peer group and also a lot larger companies, we have a significantly higher grade in the ground, and that provides a buffer for any unforeseen events. So we have a really high margin business because of that. It's almost comparable with underground operations, which are significantly higher cost operations. But yeah, this is the one side of the coin. We have this high grade in the ground. On the other side, we are managing costs. That's the one that we can actually really influence as a management team. So when we look at the production and the cost from the last half year, we see actually that despite an inflationary environment in Turkey, we were able to reduce our all-in sustaining costs. Even further important, the C1 cost, which is the pure operating cost of the mine, we could reduce by almost 50%. We could reduce the AISC by 13%. And as Artem said, in the current gold price environment of 3,300 per gold ounce, and we are producing that at $1,000, that's a really significant margin we are realizing in the business as we speak. When we look at the current operation, the oxide mine, which is basically the production site in the northern part of the license area, that's purely producing a gold, silver, doré. We have a lot of upside in that mine while we are building the other part of the mine. We can most likely continue this for a couple of years in the future. And the upside potential we illustrated here a little bit, we see in the license area that we have additional exploration potential. We see that outside of the license area, it's a very geological rich area where we are. There is a lot of other mines and exploration potentials, etc., where we can add further feed. But most importantly, also, we have already a stockpile on site that is going to be extended over the next years, which is called a transition ore or an enriched ore zone. And that is just treated as waste in all of our economic assumptions. But we have already identified a couple of ways how to treat this. And this is a clear upside potential that we're looking to realize in the next couple of months.
Thank you, Patrick. As we said, we are transitioning from production of gold and silver doré into the production of copper concentrate and zinc concentrate, essentially from the same ore body. Just the top of that is oxidized, and we're using that in a heap leach to produce gold and silver. Now we are starting to move into the sulfide. We are halfway through building a sulfide plant, which have a flotation essentially, and that's 2 flotation circuits that will give us copper con and zinc con. We are building a camp for the people. We're building a TFL, tailing facility, and that essentially it. Everything else is already at the site, infrastructure, etc., etc. So it is not very capital intensive projects. Importantly, the EPC contractor who is building it is essentially our sister company because it belongs to Chalik Holding, who is our major shareholder. So not only we have a fixed price contract where we cannot pay more than 146 million, but on the other hand, the counterparty here is a sister company with whose shareholder we have alignment of interest to ensure that project is done on time and on budget, and that is currently the case. We're roughly 50 ways through and progressing on a daily basis. We expect to reach full commercial production before the before the second half of the next year. As we show on the slide, the project is extremely attractive in terms of capital intensity at $7,000 per ton of copper equivalent capacity. This is 3 times below what the current copper projects globally can cost. We are very much on track building that. If we move to financials, I'll pass back to Patrick.
Thanks, Artem. So yeah, just a quick overview on our capital structure. So as we said, since the company was established, we literally did a couple of initiations and initiatives, to clean out the capital structure. So as we speak, we only have a bond outstanding that's traded in Oslo. It's actually trading currently at 106.75%. So the investors are realizing that we already de-risked the business. We are delivering on the milestones that we're indicating. So hence it's trading above par. It's a $200 million bond. Currently, we have $133 million in cash. So as we obviously go through the project development, we will draw more from the bond. But on the same side, we are also producing cash from the oxide operation. So we will maintain a pretty healthy net debt ratio even after the full construction is completed. And with the sulfide cash flows coming in from 26 onwards, we will also be in a position to, either pay this bond and refinance it at some point, or pay down the bond in 4 years' time when it's due. So you can see that even after the construction is completed, the NPV, the NAV that we're showing should be significantly higher. We should get more rating in the multiples from the market, and we will have a higher NAV to show to our investors. From the next page, we just look at the costs. I think we have shown that we are actually improving the asset on the gold side, because currently we are a gold producer on the gold cost curve. You see that we already improved our position to be even further down in the first quartile. That means that a lot of other companies and projects need to go under before it would come to us. But most importantly, also going forward, when we look at the copper cost curve in 2027, that's the first full year of full nameplate capacity production. We are a first quartile asset, which obviously positions us well for the long-term future of that asset. Within the team, we did a very interesting analysis across sectors. For US investors, there's a lot of other industries to invest in. If you look at mining per se, we have here diversified mining, that's already a pretty interesting margin, industry with 24%. If you look at ACG, we're currently having an EBITDA margin of over 60%. And most importantly, we're still trading at a PE of 2.7 versus the other industry benchmarks, very significantly higher than that. So that shows the undervalued business opportunity we have here. Artem?
Thanks, Patrick. Let me run quickly through the remaining slides to ensure that we have time for the questions. The strategy is very simple. It's move from one excellent acquisition to another to ensure that we build 200,000 to 300,000 ton of copper production capacity in the next 3 years or so. And if we do that, we will be the second largest copper producing company on the London Stock Exchange. And hopefully we'll have C liquidity on OTC markets in New York as well. I'm not going to go into the copper market outlook. The simple story here that supply is behind the demand. Demand is growing close to 3%, supply just over 1%. And it's a well-diversified global sector with a number of companies and industries on the supply side, as well as various industries on the demand side, from traditional construction, electricity grid, to the new ones, such as demand from artificial intelligence for the data centers and robotics, EVs, etc. All in all, it is expected that demand will outstrip the supply and copper prices will establish a new level above where we are currently trading. It's not lost on the market. As you can see, the pure play copper companies are trading at significant premium to the diversifieds, and that's one of the reasons we are focusing on building a pure play copper company so investors can diversify and build their own investment portfolios. We are working at the moment on about 10 various transactions. I've been doing M&A in mining all my life. The simple rule of the thumb is that you need to work on the minimum 3 and ideally 5 deals to get one done. We're working on 10, so there is a good possibility that 2 or 3 of those will get executed. Because we are focusing on acquiring producing assets or assets which are shovel ready, BFS, bankable feasibility study completed, we can utilize the debt in acquisitions, therefore increasing the returns on equity. The strategy is very simple. Today, we are just under $200 million market cap company. As we complete the construction and move into $100 million free cash flow after starting to produce copper concentrate and zinc concentrate, if we will be trading in the same rates as peers, we should be $300 to $500 million company. Next acquisition shall push us towards billion plus. And in 3 years, we see ourselves as a multi-asset, multi-jurisdiction producer, focusing on supplying copper to the western part of the world, and having a number of producing assets in our portfolio. Let me pause here and start on the questions. The couple of questions are similar here. One is, can both operations run at the same time? I mean, I assume the both refers to oxide plant that we have now that is currently producing gold and silver doré, and sulfide plant which will produce copper concentrate and zinc concentrate. The answer is yes. The oxide plant is in northwest of the deposit, sulfide plant being built on the southeast of the deposit. They can well run in parallel. If you look at our competent person report, which is UK equivalent of 43101, you will see that that is published on our website. It was part of the prospectus last year. You will see that the base case mining plan assumes that we'll stop producing gold at the end of the next year because we'll exhaust the oxide cap of the deposit. But as Patrick already mentioned, we are working on a technical solution to enable us to produce gold, continue to produce gold from enriched ore, which is currently treated as waste, and that will enable us to continue production gold and silver doré until we find other sources of gold, of gold-bearing oxide ore, which are plentiful around where we are in Turkey. So yes, the both operations will run at the same time. I will add, Patrick, will you look at question 4 while I answer question 5? How does ACG Metal plan to maintain consistent production rate at the Gediktepe mine as it transitions from oxide to sulfide, and what contingency measures are in place to address potential operating challenges? So I have half answered that already. As I said, we are producing from the oxide ore from our deposit up until the end of the next year, and the 2 operations are separate, so there is no operational challenges to continue to do so and achieve production according to the mine plan. So I would note it's not about consistent production. It is a production according to the mine plan, which essentially will see lower gold production this year versus last year and lower gold production next year versus this year, because we're eating through the oxide cap of the deposit, but because we benefited from the higher gold prices this year, even though last year we produced 57,000 ounces, this year guidance 36, 38, but the free cash flow overall for the company will not be too dissimilar to $90 million achieved last year. So we do not see any major challenges running these two operations at the same time, according to our mine plan. Patrick?
Yeah, I think the other question was, what is the ACG using copper only and not a copper equivalent? I think that's a question we can and shouldn't answer, because ultimately, without the equivalent, it's not comparable to all other mining assets globally, right? You need to have a similar basis for the comparison. And while we're producing copper, it's about 50% of the revenue mix. We also produce zinc, and we still produce gold and silver in the concentrates that we are selling. So ultimately, all other mines are taking this as a byproduct credit. This is why we calculate in copper equivalent. It is pretty significant, but it also shows you that we have quite a bit of precious metals still, which are running well, and is always a bit of a natural hedge against copper and zinc. But ultimately, the whole mix overall is what pays for the cost and of the mine. And this is why we report in a copper equivalent, to make it benchmarkable to other projects.
Thank you, Patrick. Next question. What are your relationship with Lydia and Argentum Creek? Are they strategic investors? The answer, yes, they are very much strategic investors. Lydia is the company from whom we acquired the asset. We paid in cash and shares, and that's the reason they have approximately 30% shareholder. Argentum Creek is a strategic financial investor, so you can say that Lydia is a strategic industrial investor. Argentum is a strategic financial investor. They were one of my co-sponsors of the SPAC. Originally, I listed ACG as a SPAC, and it became a normal operating company when we completed the transaction in the beginning of September of last year. So we do not expect those investors to be selling out of stock anytime soon. They are, like us, believe that this is a 10 times increase in the value of the story as we execute on our strategy. Which leads me to the last question I see here. How does ACG expected current undervaluation versus peers based on operating free cash flow to market cap and EV/EBITDA margin to be addressed? And what is the main catalyst to a potential market re-rating? So the fact that we are undervalued is simply the reflection of two factors. Number one, we are a new kid on the block. We're not even a year old. We only started marketing to investors 2.5 months ago. Before that, we are busy putting the base case together and building the company. So as investors on both sides of Atlantic get to know us, we expect more interest. That's number one. And number two, the only challenge that we are currently facing, it is not with the base case business. It is essentially with liquidity in shares. And how to address that? We are doing it right now. We are speaking with a number of investors, and we are looking for ways to spread the word and ensure a higher trading volumes, both in London and in New York as well. Patrick, you have 1 minute to answer the last question on the bond issue.
Yeah, which question?
With the recent $200 million bond, how ACG is managing its net debt and liquidity to ensure financial stability while pursuing sulfide expansion and future acquisitions?
Yeah, so we obviously raised the bond, to fund the capex for the sulfide extension, and this was the best alternative we had at the time, because it was the most capital beneficial option for the business. We didn't have to raise any additional equity in the market, which obviously saves us a higher return of the equity investor requirement. And we also had private equity knocking on our door, which was more expensive. And the bond market was a quick solution to finance the full project. And it actually benefits us right now because we can pay the contractors and the suppliers at an early date. We can save costs and we can maintain the schedule. And this is why we're still, after 50%, really much on track and on schedule and on budget for the expansion. For new acquisitions, we will also have an opportunity to tap that market. There's investors are seeing the bond is trading at 106%, which means that we have the ability to go back to that bond market, but we also have alternatives, and we are always looking at what is the best option for the company.
Thanks, Patrick. All in all, with $100 million free cash flow per year, having a $200 million in debt is not an issue. New acquisitions, because we are buying producing assets, can also be financed by debt secured by these new assets. We ran out of time. If you have any questions, want to set up a meeting with us, please contact Mandy here, which her email is the second one on this page. And we really appreciate your attention. Thank you.